the general way that I explain it is fundamentally the idea of if a large entity wants to borrow money, that they would go to a bank. And the promise of DeFi is that private credit, which is literally just borrowers and lenders meeting ourselves at a fair market rate, does not have to be facilitated by a bank. It can be handled on chain. But what we find with the way that Wildcat works, which again, then for everyone who's new, it is an undercollateralized credit protocol. The way that I describe it, depending on audience, is either the Tinder or Craigslist of private credit. It is, in its current form, completely borrower-driven in the sense that a borrower basically gets to create a market parameterized exactly the way they want.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features Laurence Day, co-founder of Wildcat. As we were preparing for this episode, one of the things I was reflecting on is just how I had personally written off undercollateralized loans. And I have to give credit to Wildcat for reigniting that interest.
Yeah, this was another case where I felt like I was a natural skeptic going in, but I just think we're not always used to these protocols that are extremely neutral and almost have very few rules. I feel like the simplicity in the design here is actually the feature. So sure, there's risk, but you get to decide going in if you're willing to take on that risk. So yeah, I just think this model is very refreshing in the simplicity of its design, if that makes sense.
I think the goal here is not to babysit lenders and do all the due diligence on behalf of them and assure them that you can earn 10 to 25% and know that these borrowers are absolutely going to repay their debt. They've got a pretty good track record going though right now. They've got 40 plus markets, and I believe they've only had one borrower default so far. So it's a hell of a start, and yeah, very exciting progress so far.
Yeah, we take the opportunity to really, I think, pepper Laurence with all of the, what are the risks? What happens if this happens? What's kind of worst case scenarios? And I just continually realize that Wildcat is really not in a position to be an arbiter. They're just, once again, neutral, and it's not up to them to resolve disputes. It really comes down to this like buyer beware. The user is in control. Whether you're the lender or the borrower, you got to know your risks.
Normally when we record an episode, we try to publish it within about a week's time. And so it's important to understand we just recorded this only a few days after the market flash crash on Friday, October 10th. So this is a very timely interview to understand what is Wildcat, what's Laurence thinking on behalf of all of its users who are lending money often to, DeFi, on-chain, liquid types of funds, who are in delta neutral trades, or they're straight up just doing, trades with leverage and taking directional bets. There's always a chance that, one of these borrowers can get blown up. I think this is very important to understand what the platform enables, the guardrails it does have in place, but also the real risk that we take on as lenders on Wildcat. So just a quick reminder, you can subscribe at the-edge.xyz. That's the best place to stay updated on new podcasts and new posts through the Edge newsletter. You can go to our link tree at edge_pod. That's the best place to subscribe to the Edge podcast on Spotify, Apple, and YouTube. And then a quick shout out to all of our sponsors. They are the ones that make all this content possible. We have awesome sponsors like TOROS Finance and REDSTONE. And otherwise, we hope you enjoy the episode. Grow wealth exponentially. With TOROS leverage tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. Redstone is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, Redstone delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose Redstone oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need Redstone's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to Redstone for supporting us here at the Edge Podcast and Edge Newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta neutral strategy with positive returns month over month for 3 years. Built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is currently live in private beta and will be opening for public deposits soon. Learn more at neutral.fi. All right, let's introduce Laurence, co-founder of Wildcat Labs. Laurence, welcome to the Edge Podcast. How are you doing?
I'm doing grand. Thank you both for having me here today.
So we've got you on to talk about Wildcat, but we just recently did an interview with James Craig, the director of Code is Law, a documentary all around DeFi exploits. We should talk about your story, your journey in DeFi. It starts with a legendary hack with indexed finance. What can you tell us about some of the work you did years ago, and how did we end up here today with Wildcat?
The funny thing is that my introduction into kind of working on something as not an anonymous dev was basically grounded in my background in TradFi. I'd worked in risk management for ages at a bank in Singapore. And I ended up bumping randomly into it in a Discord because I was trying to do some yield farming for tokens of the what turned out to be the NEX token, the index finance token. And I got introduced to Dylan Keller, who had written all the code. Dylan is also my current co-founder over at Wildcat Labs. So, we've been bound together ever since all of this started. And the reason that I got attracted to that was because index was fundamentally quite boring as like what it was meant to do. It was meant to like do representations of ETFs on chain as bundles. It just treated an LP token as a collection of assets that could be adjusted to like target weights and do rebalancing at will based on like external arbitrage. So, that I worked there with Dylan for 6 months. And then 14th of October, 4 years to the day, as we sit here today doing this podcast. No, not at all PTSD inducing. I've talked about it on Twitter. Attacked by who was then at the time a 19-year-old, which was a real shock to the ego of everyone involved and a bit of a moral quandary. Index never recovered after that. Of course, the protocol continued working once like the toxic bits were sealed off or disabled. But, of course, it's one of those, fool me once type things in like a very skittish DeFi environment at the time of 2021. So I took a bit of a break. Dylan Keller went off to do the optimization of what became the CPOR protocol, which powers OpenSea. So if you've ever paid more than $1 to do an NFT trade on OpenSea mainnet, you can blame him. or $100, depending on the state of the network, which I guess we can talk about with the flash crash, because I got quoted $1,000 to do a cow swap trade the other day. We're in the middle of the mix. But all of that to then subsequently say, after taking some time off, I ended up being introduced to Evgeny Gayboy, the CEO of Wintermute at the time. Well, he still is. At the time, being like when we was working at Index, and became friends. He provided a bunch of moral support and connections whilst we were performing the manhunt. And then in the aftermath of the Terra Luna collapse, we got to talking, and we were busy, doing the whole, where did the yield come from the Anchor protocol, of course, with algo stables being what they were. But the conversation tilted to, wouldn't it be nice if there was a private credit facility that existed on mainnet that had its yield powered by real-world cash flow? The thing that powers private credit in TradFi, which is TradFi's greatest weapon, credit expansion. And I said, yes, it would be nice if that existed. Sure would be. To which the next sentence out of my mouth was, I think I will go and build it. So, prompted DM over to Dylan Keller. And a couple of months later, off we went with the V1, and the rest is history.
Laurence, one thing I'm just kind of thinking of as you're going through all that, the index finance, obviously massive gut punch, and then you live through some other of DeFi's just worst moments. We've got the Luna stuff, we've got all the CeFi blow-ups, like blow up after blow up, and then you still kind of have the drive to go build something. So just kind of curious, like your mindset, why did you stay in this mess? I mean, hey, I did too, so did DeFi Dad. We all have our reasons, but kind of curious what yours is.
That all of us are damaged in unique and interesting ways. No, it's funny. I got immediately and irrevocably Ethereum pilled whilst I was working in banking. I didn't realize this at the time, but while I was finishing my PhD, the last chapter of what I was building for my thesis was, if you squinted at it, it looked like the Ethereum virtual machine. And I'd spent so much time in TradFi working around programming for money that I got really interested in the concept of programming money itself. I think this is quite a common byline for a bunch of people that become developers. Now, the irony is that I've ultimately Peter Principled myself out from being a developer in the developer sense to basically a team lead. But let's pretend temporarily that I am still a dev. I think that appeal is really hypnotic to a certain type. And I think even if you kind of took the more base desire of like the wealth effect of crypto, or just the fact that it's interesting, I keep all of my funds on chain. I deploy capital across the board here. Even after blowups, I still haven't managed to convince myself that I would like to be anywhere else. I think fundamentally, I just still believe in it. And I think what I did was I told myself some retroactive cope, especially after exchange collapses and after the opaque CDFi collapse of your Genesis, Celsius, BlockFi, etc. I was like, well, that's not true DeFi. Now, of course, I think I may be just no true Scotsmaning things, in retrospect, but which was one of the reasons why I wanted to build Wildcat the way that it currently exists, was that, it's all an open, like everything's publicly available, parameters are dictated, you don't get to perform any kind of shady side deals. But I suspect the core reason is just that I want to see it all work, and I'm being really stubborn about it.
I think one of the things that draws us all in is the freedom to do what we want on chain. There's so many guardrails in traditional finance, and it's also, of course, one of the major risks is not having the same guardrails, having the ability to risk whatever capital and, connect your wallet to whatever application. And years ago, we all lived through such early experimental DeFi, but when you look at where we are today, if you could have taken a time machine back from 2025 to 2020, 2021 and told yourself it's really going to get so much better, you just got to stay the course. I'm so grateful we all have, but it really feels like it just sort of turned a corner just in the past year or so. Like we finally are seeing real mainstream, highly credible types of institutions, governments, and so forth actually lean into the space. They're saying now that the work we're doing is important, whereas just a few years ago, we were being likened to, drug dealers and criminals and, folks that are laundering money.
If you look at articles on Forbes, I don't think that that sentiment has fundamentally changed. But you can't please all of the people all of the time. I do notice it myself. I've always kind of tried to keep my head down and just beyond like my crypto Twitter presence, but like focusing on just getting stuff built. But you're right. I think FTX was kind of the nadir of all of this, where I went out publicly and I was saying, no, this wasn't a failure of crypto. This was the failure of an opaque shadow bank. We can do better. DeFi fixes this. And then, of course, we had a year of going to the phantom zone, where effectively that no one cared anymore. And of course, there was the election in the United States and everyone wondering about like the fate of all of that. It's still happening now. You're seeing like, the Democrat proposals for market structure, which I shouldn't care about. I don't live in the United States, but I do because it fundamentally affects everything. But yeah, as you say, like the last year or so with the rise of kind of this new generation of protocols, we finally, like, DeFi's voice finally broke. So it's getting there, and it's a joy to see. Like, it certainly makes it a lot easier to go out in public and tell people, what you do. Like, I get invited now to like UK universities to give public policy chats about the impacts of DeFi. And whereas previously I would go to people in public and say, oh no, I'm an exotic derivatives engineer. Now I think, if they dig like a little layer down, I'll be like, no, I'm a DeFi guy. That's kind of what I do for a living.
Yeah, you have to be very comfortable working on ideas that are not obvious to the mainstream. And if you have your roots in like the early days of Bitcoin and Ethereum, we all built up that foundation of thinking about money and finance and how it could be reimagined. And I think what goes along with that, weirdly enough, like something that is less accepted from a DeFi perspective is under-collateralized loans. I think that what happened in the aftermath of Terra Luna collapsing and then FTX is lots of folks got blown up. There was under-collateralized loans that were thriving. In fact, one of them is a protocol we cover a lot and, love the work they're doing now, which is Maple Finance. Maple Finance had a bunch of blow-ups. So in that aftermath, I think under-collateralized loans were seen as a dead end in DeFi. And then what reignited that interest is Wildcat. So maybe you can tell us just a little more about what do you think of that history of under-collateralized loans over the last few years, and where did you see opportunity to do it better, to do it the right way this time? Like, how do we get to now with Wildcat with, I think, like $100+ million borrowed on chain?
I think we'll ultimately also end up talking about the guardrail aspect of things, but fundamentally, I think the answer to this is down to precisely as you say, that DeFi has grown up. Whereas, even if you looked back 3 or 4 years, winding back the clock, there was still a large part of it was no one on the internet knows you're a dog. No one on the internet knows that you're toxic flow. No one on the internet knows that you're quite suspect. And I don't think this was the fault of any of the on-chain protocols that were attempting to solve under-collateralized lending. Again, like one of the bylines that I keep going through is that under-collateralized lending isn't a major part of, or rather unsecured lending is not a huge part of TradFi. I think if you look back about 15 years, it was about 24% of what was available on the markets. But under-collateralized lending, in terms of like not putting up the whole amount, absolutely is, because that's where the money multiplier effect comes from. So, the reason that we get to sit in the houses that we sit in right now, or our apartments, or whatever the case may be, is because under-collateralized credit was leveraged in the traditional financial system. And before I really got into DeFi, I'd worked on an AI startup that looked at community credit. This was at a time right before the pandemic started, before saying all of those words in a certain combination got you $50 million in a pre-seed from A16Z. But I'd caught the private credit bug then. And so, of course, I was a huge fan, still am, of your protocols such as, your Centrifuge, your TrueFi, your Maple Finance, etc. Of course, I think what really got me was Aave at the time, even when it was still ETHLend. That was like my click moment. But of course, playing with relatively little, like small size, I was still sitting there going, what do you mean I have to put down like $1,000 or something to pull out 600 of a different asset? Of course, it makes sense, to avoid bad debt, and you don't know who your counterparty is. But I think when you look at scale, then you're like, well, the world operates on notions of trust and legal recourse. And yes, we are certainly trying to build a more paranoid, robust parallel financial system. And I think we can attest to the flash crash. But like DeFi did actually perform really well. I think Gwart has a really good post about saying, yes, you may have lost everything. You may have lost your son's college fund, but did you see how smoothly the wheel spun and how quickly the dealer swept all of your chips off the table? But it did work, right? Like nothing actually fundamentally, like the roof didn't come down, which is for better or worse an actual improvement. You do have people that are arguing right now for like circuit breakers on centralized exchanges currently. And I think maybe that's fine because centralized exchanges are centralized by default. You have that option. DeFi worked fine. Euler operated perfectly. Aave operated perfectly. They all did. Pendle's still going. Wildcat, and so we'll talk about the impacts of that. Everything worked as it should, for better or worse.
I want to call out one of the reasons we've been so interested in Wildcat is because there are no liquidations because of the nature of the protocol. So, there is an impact here, and we'll cover it, that obviously lenders have to consider and the protocol has to consider. But one of the beautiful things about doing these under-collateralized loans on chain is if you can get the system right, you don't worry about these flash crashes. And anyways, it's very interesting. There's trade-offs, but it is one of the real pros to designing this protocol.
It's funny because one of the things that I've wanted to introduce, or have Wildcat Labs build for a while now, is this idea of cross-asset credit, right? So in the sense that you would say, like a borrower, be they who they may, says, I want to borrow USDC, but I will repay you in wrapped Ether, right? The only reason that that's not the case right now, or not possible, is precisely because of this. People are screaming about oracles, which is always the greatest source of risk when it comes to things like in trading protocols, CF Mango markets. But also you have weird questions like if you do have that kind of facility and then you have a flash crash and someone says, I'd like to pull out my redemption now, is it at a different market price than like when someone else? What's fair between everyone? And I'd said on Twitter, when all hell breaks loose in moments like that, the demons live at the edges. So the easy answer to that, which does, of course, heavily rely on solvency and trust, and, of course, underwriting in cases where we want to get to, is that, sure, your debt itself is not going to be liquidated, but ultimately it's going to trade at whatever it can be redeemed at. But that's how markets work.
This episode is brought to you by MANTLE, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With Onchain transactions, TradFi rail compatibility, and integrated DeFi features, MANTLE is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow mantle_official on Twitter. As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's SYRUPUSDC and SYRUPUSDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and soon Aave. To learn more about Maple, go to maple.finance.
Laurence, one thing you mentioned a little bit ago is just this money multiplier effect. And it's something that, obviously people have tried this, but we haven't really tapped into it yet. So if all this is successful with Wildcat and, maybe other protocols like 3Chain, and maybe there's more that crop up when they see success, because that is a thing that crypto does. If you're successful, there's going to be about 100 more of you coming down the pipe. But what are the second order effects for DeFi as a whole if we tap into that money multiplier?
I think in order to understand the point that I'm about to make, you have to understand that the collateral reserve ratio at the Federal Reserve Bank of America is 0. Right, which is effectively that they can, spin around as much money as they want, leveraging it as much as they possibly can in order to meet the needs of their consumers or the wider environment. What you end up with in a situation, and again, a lot of this is down to trust. That's what the nature of under-collateralization or effective risk underwriting, or just kind of staring at the books and figuring what people's future cash flows look like. Money multiplier effect of getting under-collateralized credit right does, in the boring sense, just mean a lot more liquidity available for trading assets, which of course results in, this is purely if you're looking on chain, if you're thinking that market makers are your borrowers, right? What you end up with is, of course, better order books, smaller spreads, just generally a better experience if you want to offload size or anything of the sort. This is just down to the boring trading stuff. The minute that you solve this and you introduce your TradFi borrowers, say like credit funds that are seeking liquidity, or heaven forbid someone else talks about say the Ontario pension fund, because I think they're the classic example where people go, yes, do you remember FTX for me? Even though they got every dollar back and more for them, but everyone kind of takes the kick. That you end up then, and this may be anathema to some people who think that DeFi should be purely independent, you introduce DeFi in a irrevocable way to the wider markets, right? You start seeing that the Ethereum engine, the Ethereum world, or other chains. I'm not the zealot that suggests that this can't be Solana or anything else. Is fundamentally used for real world building effects. It is entities that are looking for trading capital or working capital for things. If we can get that right, be it Wildcat focuses currently on the institutional borrower side, just because there are protocols that are handling the consumer side, I think, far more adroitly than we could under the current model. But we get that right, and DeFi suddenly stops becoming what is, in the view of some people, still a niche experiment, although, we're starting to see hedge funds tokenize assets on chain. We're seeing $1 billion getting deployed into CLOs. It becomes permanent. It becomes not too big to fail is always something that's said in a negative context, but it really, really allows us to stay, we are a parallel financial system. Now, what the friction looks like, where the parallelism blurs into TradFi too much, is a question that I don't think I'm adequately qualified to answer. But being if you say a real estate entity that says, I'm looking for 80 million, I've got 40 million from a bank, I'm looking for 10 to 15 that's established on chain. Here's here's what my underwriting looks like. Can we facilitate this using stablecoins? Because stablecoins won the game everywhere now. Everyone and their grandmother is looking to issue their own stablecoin. You see this as partly the success of entities such as M0. We finally get to use money, the concept of money, which is all ultimately underpinned by trust in the violence of the state anyway, the way that we think it should be done. No, where I suppose I refer to the global network rather than centralized states. I think you can tell a little bit about my anarchist streak based on that sentence alone. But money is what we decide it is. And if we decide that we want to introduce money in that particular way, to use it using DeFi and see its real world effects, then we need to solve under-collateralized lending.
Yeah, I love that. There's so much in there that I personally resonate with. It's just users actually choosing what they think works and opting into the system that they want versus a top-down model where, we're told how it works. So ultimately, I think you just get way better products with this model. And I think this is what TradFi is seeing right now. So all of us that have experienced DeFi, we saw it and then we couldn't look away because we realized how transformational it is. TradFi is going through that experience. They're going to see it. They're not going to be able to look away. There's a massive stickiness to that we're going to see play out over the next, 5 to 10 years and, well, hopefully forever.
I'm very much looking forward to the first panicked message from a massive fund based out of the East Coast because their curve liquidity has dropped. That's going to be a very funny moment.
Yeah, no doubt. Laurence, one thing that I just realized, so we've managed to get, about 20, 22 minutes into the podcast here without even really hitting you with the what is Wildcat question. So I saw that in your docs, you have a literal elevator pitch for Wildcat. I'm curious how you explain this to people, down at the pub, wherever you may be. Hey, I'm in DeFi. You can actually tell people you're in DeFi now. So yeah, how do you explain Wildcat?
If I go up to people in the pub and tell them that I built Wildcat, I'm generally expecting them to punch me. But the general way that I explain it is fundamentally the idea of if a large entity wants to borrow money, that they would go to a bank. And the promise of DeFi is that private credit, which is literally just borrowers and lenders meeting ourselves at a fair market rate, does not have to be facilitated by a bank. It can be handled on chain. But what we find with the way that Wildcat works, which again, then for everyone who's new, It is an under-collateralized credit protocol. The way that I describe it, depending on audience, is either the Tinder or Craigslist of private credit. It is, in its current form, completely borrower-driven in the sense that a borrower basically gets to create a market parameterized exactly the way they want. So they get to specify what asset they want to borrow, how much of it they want to borrow, the interest rate they're willing to pay, how long they have to honor redemptions, whether the debt itself is transferable, all of these things. Creates an independent set of contracts, puts it out there. Even access policy is restricted based on the desires of the borrower. And then lenders are able to participate if they feel that those terms are acceptable to them.
Given how early Wildcat is to, pioneering these under-collateralized loans on chain, I'm wondering, who are you building this for? Like, who are the lenders? Who are the borrowers? I saw a tweet not too long ago. I think it was to do with the recent raise that you announced. You had a tweet in the thread that said, "We will be pushing out beyond just crypto native participants, sourcing credit opportunities from traditional markets and bringing them on chain. You will extend credit to businesses you can walk into and you will be happy." I love that.
Sure. So the V1 of Wildcat was very much built with market makers in mind. And specifically, it was built with Wintermute in mind because they had like this really deep OTC book of people that they trade and borrow from anyway. And just really kind of using them as ground zero to be like, okay, how do we remove these conversations from Telegram and just put them into a protocol on chain that people can interact with instead of having to be like, can I claim my money back? Or like, how much interest have I accrued, etc. Just be like, literally check the chain. I operate fundamentally as a crypto native person, like CT native. Again, I have a history in TradFi, but it's not, I don't look particularly great in a suit and tie. So I don't necessarily like swim in that world. I take it back. I do look great in a suit and tie. But the borrowers that exist at present are fundamentally kind of in like two major categories. They're market makers, be they running whatever strat that they want. So it tends to be on the delta neutral market making side of things, or would be protocols that are looking to borrow for, just providing operational liquidity or like bootstrapping, operations or what have you. Now, the goal here fundamentally though is, again, I've mentioned this before, stablecoins won the game. Everyone's interested in getting exposure, be like on like say family offices. You have plenty of offices like entities that like kind of sit in the shadows of more money than God, who are sitting there being like, yeah, we could allocate 2 or 3% of our portfolio to something in stablecoin that's yield bearing. Oh, that's $18 million. These people live amongst us. What we find on the lender side, so Wildcat as a protocol identifies and KYBs everyone that's on the borrower side. So it knows who's actually asking for the capital. It doesn't perform any underwriting itself. We'll talk about that later, but it does at least know who the legal entity is that's doing the borrowing. On the lender side, we don't have so much insight because the access policy is dictated entirely by the borrower themselves. And there's two main modes for that. The first one is anyone can participate so long as they meet a specified optional minimal deposit, so long as they're not sanctioned by OFAC, according to the Chainalysis Oracle. Or the other one is that people are opting for is it's specific whitelists. This is how the V1 operated. The V2 operates the same way. You can only participate in a pool if you've been explicitly authorized to do so by the borrower operating their account. Now, the flip side of that is that whilst you do have tools that allow you to kind of skip trace through and identify roughly who some of the larger depositors are, we also consider it not necessarily our business who the lenders are if you're thinking of as retail, as you and I. So we can identify the addresses and how much debt they have. And I do know that, there are some protocols that are deploying their working capital, extending that out in part. There are some family offices. There are just some people who've been around, for ages who are looking to do, to engage in some yield farming that's above the rates that you would get on Aave or Euler. But by and large, it's intended for everyone, right? Of course, from a TBL perspective, someone depositing $20 million as a protocol is, more interesting for us number-wise than 1,000 people all depositing 10 grand. But I do think that latter category is more important in terms of access to private financial credit markets, because one of the things that I'd always been pitching, when we were doing the raise and in general, when I give these talks, is these smoky backrooms where these deals happen with these really attractive rates are great, but your money, is worth just as much as the money that belongs to a hedge fund, right? It trades on a dollar value for exactly the same amount. You too should be able to like have access to that should you decide that's within your risk reward preferences. So it's for everyone. But I think what we find right now still is that, and I think a lot of this is down to like perhaps the lack of underwriting or not feeling like they're like adequately suited to gauge who the borrower is, that people will lend like $1 or $2 themselves, or to participate, but then like larger entities will happily throw a few million, which is a very funny little disconnect between like who we see on the lender side. It really does kind of cover the entire spectrum.
One question just about that borrower side, the KYB process. I'm curious, what sort of legal recourse you have on the borrowers, assuming hopefully they don't run off with funds and not pay back type scenario, but also just kind of curious how you're going about establishing the credit worthiness of this borrower and ultimately just who can borrow.
Yeah. So this is the I think the interesting and frightening part of what people describe as, how people describe Wildcat is that fundamentally the underwriting, such as it is in order to onboard, is not present, right? So Wildcat is very specifically named after the Wildcat banking era of, the initial like creation of the United States as like westward expansion happened. What happens is an entity goes through basically a sum subject, with enhanced due diligence. They're looking at ultimate beneficial owners. They're looking at, kind of like adverse media, etc., just to check, who is like asking for the credit fundamentally. But Wildcat itself is strictly neutral on like the deservedness of someone for credit, right? So it's not sitting there asking to dig into financials, taking the position that if there is an entity that is seeking to deploy capital that is interested, borrowers have profile pages on Wildcat and they have like socials that you can reach out to. And what I do find occasionally is, like I'll check Telegram and people will say, one thing that Wildcat does not do is it does not direct lenders to an individual market and say you should lend to this market over any other. Because as soon as it does that, it acts as a broker-dealer. And, I don't particularly feel like going to prison for breaking some obscure rule according to the SEC. And neither does anyone else that works with me. What would happen, though, is if you have someone that comes and says, hey, I would like an introduction to a particular party, or, I've tried reaching out to this person based on their socials here, and I haven't contacted them, they haven't responded. Can you, pulse them for me? Then that's an introduction I'm happy to make.
Yeah, I guess I'm curious still, just kind of any sort of legal recourse you have to get funds back, like that whole part of the equation.
So borrowers enter into, there's a terms of service that everyone signs when they engage with Wildcat, both borrowers and lenders alike. But what it doesn't do is introduce any entity involved in Wildcat's operation as part of the credit relationship. So if a borrower defaults, it is not, Wildcat is not in that relationship in order to hunt down. I think you saw previous protocols in the space that would do that. And that was if they did perform underwriting and they did decide that, funds that belonged to lenders were to be allocated in such and such a way. What you found there was that, defaults would happen and announcements would be made saying, we will like pursue people in court in order to receive funds. And it just never happened. They'd never got it either because probably it was perceived as not being worth it, or I think this was still even in the era when there was still a little bit of doubt about whether, this is the eternal code is law question. Is bad debt or like a default that happens in magic internet money land real or worth chasing down in court? But Wildcat itself has the position that, be it labs or any other entity that maintains it, isn't part of that relationship because we haven't extended capital to the borrower. So what Wildcat does is it provides a template master loan agreement, which can be used tied to the market. Now, this is tied fundamentally to the front end. You could still deposit into the contracts themselves without any restraints. But that allows for a more kind of concrete relationship between the lenders and the borrowers, where the actual meaningful relationship is. There is, of course, still a terms of service between the borrowers and the protocol operators itself, but that's very much more of a, you are committing that you are going, you're treating this like a credit instrument, you are going to repay it, and also, you are not willfully deceiving people that are like participating. I think any legal recourse that would happen from Wildcat as the protocol would be more on kind of technical grounds of, you guys were based out of like a sanctioned country rather than you guys have defaulted on your money. Now, of course, that doesn't mean that Wildcat itself couldn't act as a coordinating star in the event of a default. Say like, this is where, everyone that's affected, maybe meet here, or perhaps an introduction to legal counsel. I don't think legally I can really comment on that. But it's a case where you shouldn't expect, and I think this is where like a lot of the dangers, like perceived danger kind of byline runs, is that in the event of, say, like a massive default from a borrower, the protocol itself will observe and watch and help guide, but it will not intervene itself. It may have the option to perhaps on the idea of, say, that Wildcat generates revenue by taking a clip on top of the rate offered by the borrower. And there is notionally the idea of saying something like, well, we can't claim these protocol fees anymore. We have suffered a loss. We could get involved in court. But I think it's theory crafting until you get to that moment.
I think the neutrality that Wildcat is demonstrating, it's the real opportunity to be a bigger platform. I think that Morpho has been one of the best examples in the last few years of a platform that set really simple rules to be followed. And again, different approach. It's over collateralized, but they don't want to hold anyone's hand. They just want to provide a free market for lenders and borrowers to meet. And I definitely recognize that here. And I think understanding this is really important to understanding your risk as a lender. River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using SAT-USD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi. Can you just walk us through some of the usual terms and conditions we see as lenders and borrowers? What types of rates are we seeing on average for lenders? What are the borrowers paying? Is there any term to those loans? When do they expect a payback, from those borrowers?
So looking at Wildcat right now, which I actually did before the podcast started, the rates are, or markets that have more than $1 million in them, are ranging between, and these are always on stablecoins, it's always on USDC or USDT, between 10.5% and 23.8%, which is, again, like you're looking at something that's 23% and you're like, wow, okay, yeah, this is great. The funny thing is that it always kind of splits a TradFi person into one of two camps immediately. The first one is, what in the name of hypercrime is going on here that could like justify these rates? And the other side is, oh, well, we always, doesn't matter what the number is, they always say we think this risk premium is not high enough because of like the inevitable, like the counterparty risk or the smart contract risk or the fact that we're all dealing with DeFi and what happens if Circle gets a signature banked again. There's always a reason, but fundamentally Wildcat has issued something close to like, I think $400 million in credit right now. So the market's right. Now, I think the basis of these yields are fundamentally not a question for Wildcat to answer. They're just saying this is the rate that's being offered. It's down to lenders to perform the due diligence. But what I will note is that, if you're an entity that's operating, say, like, again, I'm just talking from the perspective of market makers. This is a number that always blows TradFi people's minds. You can happily return something like 25 to 30% on capital up to like a pretty significant scale, just by over the course of normal operations. So if you're able to do that and you're happy with your risk management and you're able to convince other parties of that as well, even borrowing in the teens is effectively free money. Your cost of capital is, you could halve it basically. So, but again, this is something that Wildcat itself doesn't impose any kind of requirements on. Like the buffers of the parameters of a market are miles wide. You could say like, I'm willing to pay between 0 to 100% APR on a market. And it's just a parameter within the contract of what gets deployed. I do use Wildcat myself. I don't lend to every single borrower just because, there are some minimum deposits in some cases, but I would consider myself as being a not conservative, pushing out a little bit in terms of like who I lend to, but I'm very comfortable with the rates that I get personally. But I suppose I have to be. I have to say that, I think.
Okay, so we've got a few questions more on the recent events with the market flash crash. I actually have one from a listener or viewer that was submitted before the interview. They mentioned more on the topic of monitoring existing borrowers. And I think I probably could answer this on your behalf after what you explained about how neutral Wildcat is and how it acts as a marketplace. But their question was, outside of reviewing audited financials and traditional off-chain credit underwriting process, how is Wildcat using on-chain data to evaluate or actively monitor borrowers? Any thoughts there?
So I think there's two parts to this. There's always the future-facing, like what is a borrower actually dealing with, and then you can kind of look back as well. Because one of the reasons that one of the things that I really want Wildcat to kind of be the root layer of is a credit score for institutions that are borrowing. Because you see many entities that come out there saying, hey, we're going to kind of like backtrack through a wallet's Aave history or how they interact with Pendle. And we can use that, extrapolate that data and work out how we think that they would perform in the face of an under-collateralized loan. And that's not how it works, because you can't really compare those two markets together, because, someone who's always been like threatened with the idea of bad debt and liquidation may decide in the face of an under-collateralized loan that Venezuela looks really good this time of year, just disappear into the void. That is one of the reasons as well that Wildcat currently doesn't do individual loans. So again, it's been adequately handled elsewhere. It's within the intracontinental United States. It's much harder to move a business. Yeah, kind of on the lam. Now, Wildcat itself as a neutral platform does not do this kind of on-chain monitoring, although every single engagement with a market in terms of, a deposit's been made, a withdrawal request has been filed, capital has been returned. These are all logged and they're available on the website. So you could actually backtrack and say, a withdrawal request was made, this is how quickly it was honored. You could extrapolate this to an analytics page to kind of get an idea of like historically how a borrower has performed with a given market. I think maybe pessimistically you could say that all of these things are fine, except, you've got your 1001 days in the life of a turkey problem. But you can infer some information about performance based on that. There are third-party platforms that exist out there. I won't name them because a bunch of them pivot and a bunch of them decide what they're doing. But like they will do things like perform either reviews of data in order to kind of like produce dashboards, or give you like zero knowledge privacy preserving dashboards of, say, like your CFI exposure. So if you're a market maker, then you would be able to produce a number that said, I'm just going off the dog here. Apologies to everyone. I'm just going to assume this is cut in. My dog is going nuts. That if you're a market maker, you don't want to necessarily expose what assets you hold where, because that leaks signal. But what you can do is produce a dashboard that says this is how much is being held in the aggregate. And that could be live. We are quietly encouraging borrowers to engage with this kind of process, to do that. But again, it's not mandatory in order to use Wildcat. We just think that I think everyone reasonable would think that this is the kind of thing that would be useful for underwriting to be performed. Now, of course, if you're deploying at scale, there's nothing stopping you from as a, say, a risk curator, just reaching out and being like, hey, can I have a look at some things? I'm happy to sign an NDA. But I think that kind of thing would be much more useful for like the you and me. Now, whether, I think the prevalence or impact of something like that will have to be seen as Wildcat matures.
I could see an opportunity for the types of vault curators that exist with Morpho. Maybe folks like that will... Actually, what am I saying? I'm already seeing some of this. There are clearly folks running vaults who are lending to Wildcat as part of the underlying strategy. So, it's not necessary that we're all lending on the front end of Wildcat. I see what you're building as a much larger platform where we're going to benefit as lenders across the more like automated one-click types of yield vaults out there.
Yes. So there is a focus right now on these kind of abstracted vaults to exist, just because it does allow you to kind of maybe mentally defer the risk rate underwriting to someone that does this for a living. So we are seeing some platforms that do precisely this. But I think one thing that's really important is, and this model was exactly what existed in the previous cycle, in that you would deposit assets into a market and then someone who was acting as a risk curator would decide where they went. But that was great, but it also meant that you didn't get the option to kind of elect not to lend to a particular person, right? I think that the existence of the abstract vaults is great and something that I really want to see kind of become more prevalent. But it's also very important that you do always have the option to go further down to the metal and extend capital to a particular borrower if you wish. I think that was maybe the missing piece of previous attempts at solving this.
So Laurence, we talked a little bit about the flash crash, and I'm just kind of curious holistically, some of your maybe biggest worries. What are the risks that maybe keep you up at night? I'm imagining maybe the flash crash was a tense moment on October 10th, but maybe it wasn't. I guess curious as an outsider, how do you know what some of these borrowers have done with what they've borrowed? And I guess it's very possible that some of these borrowers were highly levered and got totally wiped out in the flash crash. Like, just curious your overall thoughts of that and any other risks that you want to call out that worry you, I guess.
Of course. I mean, earlier I alluded to the index finance attack, right? So I'll tell you that the one that keeps me awake at night is a smart contract exploit. I think anyone that's kind of, done any development work knows, like, that's the thing that, like, gives you the heart arrhythmia. The flash crash happened. I was actually laying in bed while it was taking place. It was like 8 p.m. I'd been to the gym. I was tired. And of course, my phone starts popping off. And I'm like, oh, what's going on here? And of course, like the Schadenfreude of anything happened, and everyone's wondering, like who's dead in the water. Everyone just pointed at everyone. It was very much the Spider-Man meme. And Wildcat itself doesn't have liquidations as such. We've talked about that already. So my gut reaction, of course, was, well, who's died? Everyone was saying, this looks like it's going to be a fund. It could be a centralized exchange. It could be a market maker. I think maybe this is just part of having like gone through so many shockwaves in the past that like my immediate reaction was, I suppose we'll find out in a few days. But the direct net impact of the flash crash on Wildcat was exactly what I wanted to see, which was, there's a big ripple that's appeared in the markets, and everyone that's extending credit is going, no, not right now. Thank you very much. I'd like my capital back. So Wildcat, one of the parameters of it is how long a borrower has to honor redemptions. Like, it just works on a withdrawal cycle type epoch. The actual details of which are basically, do you want to get your money back in 1 day or 7 days? And it's something that's presented to you up front. So you just saw immediately a huge queue basically across every single borrower. Just be like, I would like to withdraw my capital now, actually. I'd like to get paid back. And seeing that process, I don't think everyone is like fully honored yet. I think there are some that have got 7 days that are waiting to see exactly how much they need to repay, and then are going to repay it. I say going to. I assume that's happening, but again, I'm not an oracle. But seeing that the repayment again, like Winsomute is like has a 1 day. Most of its markets are 1 day, and they just immediately processed all exits. That is proof positive of saying, okay, like they must be fine because they're honoring millions and millions of dollars of withdrawals like on the fly, which I think also helps. One of the big reasons that I've mentioned in the past about wanting to build Wildcat the way it did in public is that you could see these things in real time, as opposed to in the when you started seeing stuff collapsing previously, where you waited weeks for all of kind of like the callbacks to happen to find out, who doesn't have the money, you can see, I think if you look at Wildcat right now, which of course is going to be released a while later than when we're filming, but everything's healthy barring like one or two, and that these ones are just pending, like they're waiting for people to repay it. And that kind of really puts out it's what I wanted to see. Of course, no one wants to build something, see the TVL like crawl up and then drop massively. But in the case of under-collateralized credit, I would be happy to see it go to zero because it means that every dollar was honored, right? If you have this like baseline of stuff that say you're like, well, it's in a market that's not being repaid, that's a bad thing. So, be it dropping down and then going up again as the market requires it is healthy, I think. Of course, what I would not want to have seen, and I admittedly actually just closed my laptop after 2 hours because I was like, well, there's nothing much I can do here. And I couldn't get a trade across on Ethereum mainnet because of the gas prices. I was like, well, there's no reason for me to be awake. You don't want to get the message from a borrower or like see a post from a borrower going, yeah, we've melted. And funny because that's awful for everyone involved. It's awful for the borrower themselves. It's also awful for the lender. But I think if you're being strictly neutral about this, then the take that you have to take is under-collateralized credit does carry risks. That's where the risk premium comes from. If it was risk-free and you would always be guaranteed to be returned your capital, you shouldn't be getting yield above the overnight rate. I think that's something that does need to be borne in mind. Like the reason that you could do looping and there's notion of leverage that's there, and you can unwind stuff in like your over-collateralized DeFi stuff. But when you're dealing with credit, the risk premium is there for a reason. It's up to the lenders to determine whether that fits their profile.
Something you're like calling out there, Laurence, is this notion of buyer beware, and I feel like the lack of guardrails is almost like that is the feature. And a lot of people, especially if you're coming from if you're not used to DeFi, this is a complete shock to the system, right? Getting hit with something that's this pure neutral substrate that lets people just come together almost like peer to peer. But you mentioned something in DMs that you're working on something to offset even more counterparty risk. And, I didn't even bother to pry into it because I figured I'd just ask you on the podcast. So yeah, curious what that is. So
there's two things that we're focusing on. One is very expected, and the other one is going to make everyone that ever lived through 2008 put their head in their hands. The first one is just a notion of collateralization in an asset that's different to the base. So right now, for better or worse, everything in Wildcat is unsecured in the sense that most people are electing for a capital reserve ratio in the market of 0. Because if you say, my capital reserve ratio is 10%, that means I can only borrow 90% of what's been deposited into a Wildcat market. That works because it leaves a buffer for people to pull out maybe some interest before they hit their principal, but it does mean that the effective APR being extended by the borrower is not quite what they're offering. Like the 10% becomes 11% like effective, and it complicates some of the accounting on their part. But so again, for that 0 has been a thing where people go like, oh, well, there's literally nothing backing this. We're about to introduce a feature that allows for you to any existing or future contract market that exists on Wildcats to arbitrarily collateralize it with an arbitrary asset. So if you you say like, oh, I want a risk weight of like 50% because maybe a family office that's you're in contact with says, so yeah, we'll extend this capital to you, but we want to see 40% in Bitcoin of the notional. That'll be possible. If you want to see, if you're like lending to a DAO that says they've got like a token that's a little bit volatile, maybe it doesn't have like a huge amount of liquidity, but it's still valuable. Be like, okay, cool, yeah, we'll lend you capital. We want 700% collateralization in the base. That's possible. It's all going to be there. You'll be able to liquidate through arbitrary call data, through arbitrary venues. So that kind of allows us then to subsume. I'm not going to be so proud or so egotistical to suggest that it'll subsume like the Maple and Aave models or the Euler model, but it does allow you to kind of produce a simulacra of that, to say, hey, we've got someone that's over collateralizing 160% in Bitcoin and they're looking for $10 million in USDC. You'll be able to do that using Wildcat now. And again, like more esoteric assets as well. Hey, we've backed it with tokenized Milady. If you want to liquidate it, you can do it through a blur market or whatever. That'll be possible. And so that allows also for then counterparty risk to be offset a little bit by saying, I know that there's at least this much that sits in there waiting to be liquidated in the event of a default. Like it's the padding that's there. The second one is credit default swaps. Of course it is, right? The idea that you could have a third-party entity look at a market and say, this borrower is borrowing $50 million. We can perform some really deep due diligence on their books. We reckon that we can calculate roughly what the parameters are going to need to be for their protection and premium legs. We can offer $5, $10, $15, $20 million worth of protection in the event of a default. Now, a default in this context is very easily observed by just literally checking the chain with timestamps, like how much time has been spent in a particular state according to the terms of use. So you could find risk curators or even just parties that maybe don't necessarily want to extend credits, that are like crypto curious, have some money and say like, yeah, we're good at underwriting. We reckon we can do this ourselves, would be able to still participate in this kind of notion through underwriting with this, again, a CDS. Now, the interesting thing there is that I think we're still planning this out, is what you don't want to do is have a would-be borrower that knows that they're about to collapse and goes, well, I will now buy up all of the CDS protection, because then it's a payday for them, because, or someone that works there. You don't want to like have that kind of adverse selection at play. So, maybe a constraint on something like the debt is only like the coverage is only available to a party that already has extended capital through a wildcat market. What that buys you is it's an independent party that's providing the underwriting. So, at least you would expect for independence, also because they don't want to lose their money in a default. But what that does is that provides effectively an insurance fund, which is greater and more fine-tuned than something that could be provided by, say, Nexus Mutual. So again, like, if an individual party collapses and there's a CDS coverage on that, then at least that it's easier again to perform a notion of underwriting, because there's, in the presence of that, you could have, say, the full amount of would-be coverage also then sitting there deployed into Euler in order just to be yield-bearing in the meantime, instead of just sitting there waiting to be called up in the event of a default. Of course, there's other bits and pieces you can do, but these are the things that Wildcat Labs, as developers of the protocol, can actively work on. Other things such as external underwriting through third parties or risk curators are kind of up to borrowers to engage with. But these are things that we can contribute to the protocol itself to make, whether they're used or not, or engage with, is ultimately up to the borrowers. But if someone really does come quite committed and says, I want to be able to provide as much assurance to a would-be lender as possible, I can partially collateralize, I could over-collateralize, I could engage with a party that wants to provide some kind of credit default swap coverage. And that makes it then a lot more appealing to everyone, basically, because you know where you stand.
One quick question, just on the option to provide some collateral. I'm thinking kind of some of the long tail stuff, like you gave that 700% over collateralized example. How curated or permissionless is this going to be with, what tokens you're allowing into that basket of approvable collateral?
Again, as a strictly neutral entity, it could be anything. I think right now, I think we're looking at, what you don't want to do is see another, again, with respect to the platform, like a curve situation, right, where you see a bunch of bad debt introduced just because things go down. But again, I think if you were to say that, I don't know, BERV, let's imagine there's a BERV token that's out there and someone wants to provide that as collateralization, so long as everyone's kind of aware, I think there could be some analytics provided about this is what the liquidity depth looks like for this amount that's sitting there, based on maybe a Uniswap oracle. I think that's all in the art of the possible. But if someone then wants to hit the pay me button, I think you get what you have there. I think everyone, this might require a bit more explaining to someone to be a wrapped ether is not the same in terms of quality of collateral as a DAO's token. And you should perhaps consider that when you're you're performing your underwriting. But again, we have to have a neutral position on this. In
having that neutral position, does that mean that if, let's say, I'm a borrower and I voluntarily put up 200% collateral for a market where I'm looking to borrow maybe as much as $10 million, are those tokens, the collateral I put up, will those be locked, or is that something that I'm voluntarily putting up and I could essentially start to attract capital, borrow, put that capital to work, but then one day I withdraw and, basically signal to everyone, hey, there might be something wrong here. Suddenly the borrowing rate spikes because folks are withdrawing, their excess capital in there. Anyways, I'm just curious how that might work.
The current version of what we've been working on just has them locked. They sit there, they have to be locked. They cannot move until a market has been terminated. And in Wildcat's parlance, a market being terminated means that every dollar of debt has been repaid so that everyone can pull out. And then and only then can you reclaim the collateral. That's not very capital efficient. Of course, if you're dealing with something that could be potentially yield bearing, so that there's like a 1.1 or a 1.2 that we could think of working on, which deploys that capital into a money market or a lending protocol. Now, of course, subject to how much, because you might not necessarily be able to pull out exactly as much as you need to. So the conservative approach being taken right now is: here's your Bitcoin, here's your Ether, here's your whatever token, your BERV, and it's just sitting there locked and waiting. So there's no option necessarily for it to be pulled out to be like, yoink, that all of the would-be backing for this is gone.
That is so interesting. I love this because I want to see that dynamic play out in the neutral free market that Wildcat enables. I want to see how many folks start putting up however much collateral, and does that drive other blue chip borrowers to do the same. But then I imagine there being some overcorrection at some point and them realizing, hey, this is not capital efficient.
We don't need this much. Yep.
Right. We're defeating the purpose of what this platform was for. We've got, if you're Wintermute and they've got a great track record already, paying back borrowers and offering near instant redemptions, why are we putting up all this collateral? That is such an interesting, neat idea. It feels like you're taking lessons from what we love about Morpho. This is really cool. I think it's going to be a hit once you have that available. That is really exciting.
I'm hoping that 2-3 years down the line, we'll be able to kind of look at all of the index data from all of this and tell a really interesting story about kind of how dynamic markets end up working. God willing, not too many more flash crashes in the interim, so we have sufficient liquidity to infer some lessons. But if I knew what the market had in store, I'd be a lot richer than I am now.
And this is, again, why there's an advantage to making these under-collateralized loans on chain work, because now when those folks put up that collateral and it's reassurance for us as lenders on the platform, we don't have to worry about these flash crashes overnight. I guess you still have to worry about what they're doing with the working capital. But Laurence, I think this is probably a good place, though, for us to start to wrap up. So just first, I want to thank you so much for spending extra time with us today. I want to remind our audience they can learn more about Wildcat by going to wildcat.finance. They should follow WildcatFi on X. Follow Function Zero. The O in function is a 0 and the O in 0 is a 0. And then, Laurence, any final word for us? We would love to have you back in the future. We'd love to talk more once these new features, this new version releases. Feels like something our audience could benefit from as DeFi lenders.
I'd love to come back once these things are in place and more mature. Hopefully I'll come back and it won't have been 4 days after an incident. Let's put that there. But I think the longer that Wildcat exists and, kind of the more time that passes and the more data that accrues as people behave, does get to tell you a really interesting story about kind of the state and the maturity of crypto as a market. Now, obviously, we don't necessarily just want it to be crypto borrowers. I'm hoping, and we're specifically hiring out into this, to look for origination of more TradFi entities that are going to participate on chain, right? So you have something that, maybe a lower yield compared to the stuff that's available right now, but has a lot more kind of proper underwriting. And again, this real world effect of being able to lend to a business that you can walk into and be happy. That is all on the cards. It is all just a function of time. So I hope that in a couple of months, I will turn up with a slightly whiter beard and a much more interesting story to tell you about how things have gone.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.